Good evening. I'm Peter Resnicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, March 20th, 2022. I've titled this video Out of the Woods because from a technical perspective, we are actually somewhat out of the woods. If you recall in last week's video, I talked a lot about the importance of trend lines and how trend lines are absolute. Trend lines fall under the umbrella of everything that we look at here at ShadowTrader that we call MGI, which is market generated information. And market generated information is essentially what the price action does on the charts. It is that information that is not opinion, it's not hyperbole, it's not news, it's not all of the above. It's basically what all of the different catalysts that may be acting on the market, it's how the market reacts to that information and the actual price action that it prints on the charts, which is really all that matters. So those trends are now broken in the S&P and the Nasdaq this week. And interestingly enough, it happened on the heels of the FOMC increasing interest rates, which we knew they would, and it was kind of priced in, but it was a little bit of a hawkish tone in the press conference where Powell was basically laying out the case that he's going to be raising a quarter point every single meeting from now until the end of the year, basically, and still leaving the door open to, a faster pace should inflation warrant it. But regardless, market obviously felt that the quarter point was priced in, basically thought it could handle it, and we had a big move up on Wednesday, followed through on Thursday, balancing out a little bit on Friday. I'm actually speaking to you on midday on Friday right now, and brings us to this chart right here. So let's have a quick look at the S&P and the Nasdaq 100 and look at the trend line breaks that have just occurred. Again, we're drawing from the all-time high. Classic example of a secondary trend line and a primary trend line. And again, this is the Wednesday activity here on the FOMC. Broke the secondary, closed really strongly. Thursday, as I was saying, was the follow through. Thursday was really the big day because Thursday is actually when we broke trend. And now, as I speak to you on Friday, we are chugging higher towards the 50-period moving average on the daily. So obviously trend completely broken in the S&P. And I do want to make a short note here just on the price action that's happening right now as I speak to you on Friday. It is a quadruple witching day, which is usually a more balancy type of day. It's a monthly options expiry, but it's also a quarterly options expiry, which is important. And those types of days are usually more balancy. I had a feeling earlier today that there was potential that maybe the S&P wants to hang out around that key 4,400 level because it's a big round number. And yet we're actually rallying over the course of today. You can see here we're actually at the high of the day closer to 4,420 than 4,400. I just wanted to mention this because it's a classic example of when what should happen doesn't, meaning that the market to me should be a little bit more two-sided today, and yet the buyers are still at it hot and heavy. So just something to keep in mind as we carry forward into next week, basically. It should be a little bit more balanced out, but actually very strong. So buyers definitely in control here as they have broken that trend line. Let's take a look at the NASDAQ 100. NDX right here, as I was saying, onto the NASDAQ 100. I think there could be somewhat of a resurgence of tech happening in this market. It's been weak for a while. I'll get into that a little bit later in the video, but the NDX is interesting in that it only has the primary downtrend line. There is no secondary, and as you can see here, same thing. Wednesday, FOMC broken, Thursday follow through. But look at the activity today, how much bigger that candle is than the SPX. Really, really strong. We're seeing this sort of resurgence in tech here, and it's happening as the NDX was relatively weaker for a long time. Now it feels like the tide might be turning. Notice that it is still further away from the 50-period moving average on the daily. That's interesting because I think it's going there. It's probably going to be pulled as a magnet. Tells me also that I've got a little bit more room to run in some of these tech stocks until I get up to that 50 MA. But bottom line is NDX also breaking downtrend, no longer in a downtrend on the NASDAQ 100, as true as well for the S&P 500. So as I was just saying, seems like tech stocks are getting a little bit of a resurgence here, which is of course great for me because those are the names that I enjoy playing the most. But one of the other sectors that's also heating up a bit that I think looks great on the chart is XLY, which is consumer discretionary, also a relatively heavy weight in the S&P. On an intraday basis, okay, remember, you can always see this relative strength, relative weakness picture very, very easily using the new weighted AD script that we have for sale on our site. I just wanted to show you how this looks today on Friday, because it's so glaring how big the divergence is between the weighted sectors and the unweighted sectors. As I'm speaking to you here on Friday, at the top of the list right now is XLK, which is tech, and of course XLY, which is consumer discretionary. If you were to look at a sector minder right now, I'm speaking to you about midday, about 12:15 or so Eastern time on Friday, XLK is up the most from the open, and XLY, consumer discretionary, is the second sector that is up the most from the open. And that's what's causing this chart to look the way that it is, where you see that the weighted sectors, which is the histogram, the sectors that have heavier weight in the S&P, are so much stronger than the unweighted sectors, okay? And this is kind of a sign to me of a market that's getting a little bit more healthy, because also, if you think about it, a lot of the unweighted sectors are the more defensive type of sectors, right? That's where you have XLU and real estate and materials and things like that. These are all sectors that have much smaller weight in the S&P as opposed to technology, healthcare, consumer discretionary, etc. So really interesting picture. I'm such a big believer in this new indicator that we came out with, and you know I'm kind of showing it a little bit every week because I like to show it off, and we're real proud of it. It's working really well. But I specifically felt like today, speaking to you midday on Friday, was a good time to show exactly what's going on with this, because we rarely see the divergence between the weighted and the unweighted as large as it is today. And it's really, really huge. I mean, you can see, you can just trace this weighted line here, and I'm just going to trace it so you can see it clearer. That white line is a representation of the unweighted sectors, meaning just giving everything a regular weight, doesn't matter if it's technology or utilities, that's that. And then the histogram is here is the weighted, which is of course giving the proper weight to sectors such as technology, consumer discretionary, healthcare, etc. The sectors that really powered the S&P and you know make up so much more of a bigger part of its price. All right, so interesting today, definitely on the weighted. We have this for sale on our website. Hit the stocks tab at ShadowTrader.net, and this is called the weighted advanced decline line think script. As I was just discussing, XLK, XLY, two sectors that are really strong today on Friday, March 18th. This is a daily chart of XLY, consumer discretionary. And there's a couple of things technically in this chart that drew me towards it and why I like some of these names going forward. Obviously, it's got the requisite trend line break that we're seeing in the S&P, et cetera. Makes sense coming off the high. But one of the other things technically that I like, and I look for this in a lot of charts, is what I deem the 100% retracement. It's when entire moves are retraced fully and you get this sort of zigzag back and forth. And if you notice, when these stocks started selling off here heavily, they then retraced 100%, took back the entire move. They then took back that entire move to the downside, and now we've done it again, and once again we've retraced 100%. I think the odds are relatively low that we do yet another move down to the downside, especially because this last move, this third retracement, broke trend, and that makes a big difference. Now, the odds are definitely lessened, as I was saying, that you would return to the lows because the trend is broken, and trend line breaks are like a self-fulfilling prophecy. Not that many people are looking at them, but they just work because, I don't know, people don't really realize that the trends are broken and buyers come in, et cetera, et cetera. These things just simply work. I've pointed that out over and over and over. And I often tell people very often that really this is the crux of what I do in terms of how I look at the market. I just draw horizontal and diagonal lines, and I look for areas where trends are, you know, either confirming or denying, broken, unbroken, et cetera. I'm always a big believer in keeping things very, very simple. I am not an indicator person, and I've stated that over and over for years and years and years. I have never used RSI. I have never used CCI. I've never used MACD. None of this stuff. All of this stuff to me is just indicators that are lagging. They're just another way of restating price and volume, etc. And they don't really tell you too much. And more importantly, why I have a problem with a lot of these indicators is that they can very often stay in an overbought situation for long periods of time, or stay in an oversold situation for long periods of time, and you'll be banging your head against the wall, buying or selling or whatever, because your indicator is in a certain area. So to me, like I said, keep it simple, keep it with trend lines and technical patterns and things like this. And again, this XLY is looking good to me. Interestingly enough, in this consumer discretionary, what do you think are the top 3 holdings? It is now Amazon, Tesla, and McDonald's. And of course, in keeping with the theme of putting my money where my mouth is, because that's what I do every single day with my subscribers in Weekly Options Advisory, we are actually biased long in Amazon, Tesla, and McDonald's going into next week. We've got a lot of short puts here in Amazon, which we sold really at a good price a couple days ago when volatility was still a bit higher. We've got a risk reversal in Tesla, so short puts, long call structure, something going on also in Broadcom, AVGO, and McDonald's, which is really interesting. We just put this on today. Again, I'm speaking to you Friday the 18th. Interesting structure in McDonald's. We're long 240 calls, but short 3 times as many 250 calls, and we're going out a couple of weeks to April 1st. I'm not going to get into the chart. I'm going to leave that for you as a homework assignment. I want you to pull up the McDonald's daily chart and look at how beautiful it looks in terms of the tight consolidation after the big move up, and then look where the 250 resistance is couple weeks out, and then think about this play of buying a 240 call and selling 3 times as many 250 calls, and you tell me if you think it makes sense or not. All right, check out the McDonald's daily chart for that information. But anyway, that's where I am biased in terms of Weekly Options Advisory and my own trades going into next week. Like the tech, like the consumer discretionary, like the fact that we've got some trend line breaks going on, and path of least resistance should be a little bit higher. And that's all I have for you this week. I will leave it there. But first, let's do a little bit of recap of what we were discussing in this particular video. The main takeaway is that the trend lines have broken. The primary downtrends in the S&P and the Nasdaq 100 are now broken, and the market is officially no longer in a downtrend. And that is market-generated information. That is not opinion. Now, going forward, could we still fall out of this pattern and move back down aggressively? The answer to that is yes, but the odds of that are less now that that line is broken. I fully understand that we are in a very tenuous period right now where some heinous events are happening overseas in Ukraine, and we also just had a rate hike, and we do have an inflation problem which could get worse in this country, which would spur the FOMC to raise rates faster. I understand all of this, and yes, all of this is on my mind as I'm starting to get more long biased here. However, remember this. Ukraine is not market-generated information. Rising rates are not market-generated information, nor is inflation market-generated information. Only what we see on the charts and how the price action reacts to the aforementioned catalysts is market-generated information. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.